Hey y'all, we're Dustin and Danielle, a brother and sister certified financial planner professional duo at Toujours Planning. We're here to share what you need to know about money, wealth, and investing so you can start paving your own path to financial freedom and independence today. We are continuing with our series covering COVID-19, coronavirus, and the crisis that is happening in our economy. And today we're talking about the stimulus packages that have been passed. And we're going to break those down for you, what is inside each one of those, what it means for you, and also what may be coming in the pipeline. Now, one of the things I want to address before we dive in is the words and the terms monetary and fiscal have been passed around a lot with these stimulus packages. So we want to break that down for you first. What is the difference between monetary and fiscal policies, Dustin?
Yeah, I'd love to answer. Monetary stimulus is usually done by the central bank of a nation, which in America, it's the Federal Reserve. Okay, so they have two main weapons of monetary stimulus to control a crisis. And we've learned these things over the past 100 years, what works and what doesn't. And both of these have been employed in the Great Recession, the financial crisis, and they're starting to do it now. The first weapon that the Federal Reserve have is to cut interest rates. Okay, so by cutting interest rates or the Fed rate, this is the rate that banks can borrow from the federal government. Okay, so basically they can cut interest rates very low. So that means the bank has access to cash really easily, and they don't have to pay a high interest rate for it to borrow from it. And they're supposed to pass on those low interest rates to us. So whenever they cut interest rates, the banks will cut the interest rates too. And this stimulates people to buy things more because people may go buy a house if their mortgage payment is a lot lower because the interest is lower.
Just to interrupt you real quick, that's what ended up happening after the financial crisis in 09, 010. Those interest rates were so low and it got people buying homes again because of those low interest rates and cars and other big purchases like that.
Right, it just stimulates people to buy things more and it stimulates the growth of the economy. The second thing that they can do is something called quantitative easing, which they really put in force after the financial crisis. So this is usually done, they don't think cutting interest rates is good enough. This kind of gets things going a little bit faster. And what quantitative easing means is that the Federal Reserve uses their central bank and their money to purchase financial assets, such as they can buy stocks, they can buy bonds, they can put money into financial institutions. So what they do is by buying lots of things in mass, they're able to prop up prices. So if there's a collapse happening and stocks are falling and banks are falling in value, they can come in there with their might and purchase this temporarily to prop up the prices. And by doing that, everybody thinks, well, the Federal Reserve, which kind of has unlimited money because they can print anything, it gives everybody a sense of confidence that prices aren't going to fall as fast. Okay, so that's the two things that they could do. Now, they don't usually like to do this much because it can be inflationary in the future. So, for instance, by cutting interest rates real low, it can spur a lot of economic activity and it could lead to a lot of inflation. It hasn't happened since the Great Recession, but that's one of the drawbacks. So they don't like to do it too much.
Gotcha. Okay, so what can fiscal policy do as opposed to monetary?
Right, so fiscal policy, that usually comes from Congress. So that's the power of the purse in a way. Now, this kind of goes back to liquidity that we talked about in other episodes. So it's all about pumping money and getting money in Americans' hands to spend. Okay, so it's directly giving money to people. That's fiscal policy. So it has to be done by Congress, and it can be done usually in two different ways. They can cut taxes, so people get money that way, where their paycheck, if they, for instance, during the financial crisis, they cut payroll taxes for a while. So that means people got a little extra money in their wallet with every paycheck. And other taxes too they can cut. So it's got kind of a delayed reaction. More people would have more money. Another thing that Congress can do, which they're doing now, is basically putting money in people's hands. They call it helicopter money sometimes for funny, just jumping a bunch of money out from a helicopter and everybody grabbing it.
That's a great visual.
It's funny, but it works. So Because when people have more money, just like we talked about in our liquidity episode, they'll spend it, and that keeps the economy going. So different things work for different times. You may see sometimes where the Federal Reserve or Congress will do, depending on the scenario, they'll do more of one than the other.
And I like how you use the term weapon, because I do kind of picture it that the government has like this arsenal of weapons that they can use. And depending on the situation, depending on the urgency, depending on the timing, they can pick and choose which one fits the bill the best.
Yes.
Now that we know the difference between fiscal and monetary, what has actually passed so far? What's been deemed as the stimulus and how does it affect us?
Right. So already we're like seeing almost immediately like all of the weapons being used at once, which is kind of cool. It's good because one thing we've learned about the financial crisis is you have to move fast or things can get worse really quick. So that was fresh on everybody's minds because it was only 11 years ago. So you've seen people move very quickly. And to be honest, we haven't really gotten over a lot of the issues from the last crisis. So immediately you saw monetary stimulus happen, which is done by the Federal Reserve. Interest rates were relatively low anyway, but they just went ahead and cut them, I think, all the way to zero. They were just like, screw this, we're going straight to zero. We are already low anyway. But they also realized that that's probably not enough. It's not as big of a move. During the financial crisis, interest rates were a lot higher, so cutting it to zero was like a huge thing. So they knew that that probably wasn't enough. So they immediately went into quantitative easing too. And basically, a week or two ago, the Federal Reserve said, we are using unlimited resources to prop up whatever we have to do to prop up this economy and not let it fall apart. So they use the power of the Federal Reserve to buy instruments to make sure things don't get too low in value, which could stem an economic collapse.
Just by saying that is powerful too, because the stock market, as we've talked about, is based on perceptions and it definitely does not thrive on the unknowns. So by saying what's coming in the future, that's helpful for the economy as well, because those expectations are set. And I think that sets the stage better than we don't know what's going to happen. As soon as you introduce unknowns into the stock market, that's when things go right. But when you start talking about what is coming down the pipeline, that in itself is good for the economy.
It's funny because the entire world financial system and a global economy is all about confidence. So you're absolutely right. So the next thing is the fiscal policy. We moved fairly quick on that too, because we've never seen a situation like this too, where the global economy almost kind of grinds to a halt. At least during the financial crisis, people were still going to work, doing stuff, things were moving, trade was going fine. It was just different issues. Now, most people are staying home. We've never seen this before, so we're throwing everything at it. So there's been 3 major laws passed by Congress. First 2 weren't as much stimulus. First one has to do with funding testing and infrastructure of the virus in the medical community. The second one had to do with the expanding paid leave. So it's called the Families First Coronavirus Response Act. It expanded the disaster loan program by removing some of the restrictions. So that was good. So it was a little bit of stimulus, but I think everybody knew pretty quickly like that was not enough. The third act that was passed was the CARES Act, which stands for Coronavirus Aid, Relief, and Economic Security Act. So this was pretty large, $2 trillion in aid for American workers and employers. To quickly go through what it consists of, first of all, it consists of individual assistance to people and families. So there was, it looks like, to $1,200 for adults and $500 for children of just direct helicopter money to people. And of course, it's phased out the more people earn. So that comes in right away. Also, it expanded unemployment benefits. I think it increased unemployment benefits like $600 a month or so. For education for people, it was relief for student loan borrowers, so they were able to freeze their payments for up to 6 months with no extra interest. It helped colleges and universities deal with this too, so a lot of money for them. The second part has to do with small business assistance. So the big one was the Paycheck Protection Program, which basically allows any business, employer, contract worker, gig worker to apply for this loan program where basically they can get a free credit line to pay, I think it's 8 weeks or 2.5 months of payroll for their company also to put group health benefits, insurance premiums, their rent and mortgages on this, interest on debt obligations, and utilities all on this for 8 weeks or 2.5 months. And it looks like they're probably going to forgive almost all of that. So this is huge for every company in the nation. And they have to keep people on the payrolls, or at least if they've laid them off, they have to hire them back by, I think it's June 2nd or June 15th. This is all about keeping all the companies in America in business and keeping people hired and incentivizing the companies to do that, putting money in their pockets. So that's coming out, allowing people to apply for that starting April 3rd. And they're able to do that all the way till beginning of June. Another part of Small Business Assistant is they released a number of tax credits too, delaying payroll tax. There's a lot of other small things in here, extending grants, things like that, that help small businesses.
Those will have effects later down the road, not necessarily right now.
Yes, definitely. And it also helped people that are retired or people that need to access their retirement accounts without having penalties. So if they're dealing with COVID-19 affected individuals, they're able to pull that out without penalty. And they waive required minimum distributions. So people that are over 70 or 72 anyway, they don't have to take money out of their IRA and get taxed on it this year.
That's a big one. Dustin, did they do that during the financial crisis? Do you remember?
I don't think so. I don't remember that. And then, of course, they have large business stimulus companies that have over 500 workers, but fewer than 10,000 employees. And so they have a lending program straight to the Federal Reserve for those companies, something similar to what we're seeing with the Small Business Paycheck Protection Vision. And then there's a lot of support for hospitals and frontline healthcare workers. And also there's support for state governments, because state governments have bills too, and they rely on tax revenue. And if people aren't spending money, their state government dries up, and there's many people that rely on state government benefits, including schools and many different programs. So it provides money for them. And it looks like, for instance, Louisiana got $1.8 billion to help with that. So a lot of stuff is being thrown out there.
That's great. Yeah, I mean, it's definitely good to see that, but there's already rumblings that all of this may not even be enough. As you know, this is something nobody in our lifetime has dealt with, pandemic like this. Still so much uncertainty and unknowns. So there's talk of a fourth stimulus package. What do you know about that and what's coming?
Right, and the rumblings are because we don't know the extent of this, because what we've learned before is it's way better to overshoot than to undershoot, because if you undershoot, it can have disastrous consequences that are irreversible. If you overshoot, yeah, it may cost a little bit, but the drawbacks aren't that high. For instance, and I forgot to mention this earlier, federal government, we are the world's reserve currency. So the safest asset in the world is US Treasury bonds, okay? Because we're able to print money, and everybody in the world uses American dollar. It's the currency that everybody uses. We're able to just print money, basically. Because everybody in times of crisis rushes to safety and they want their money safe, all the countries of the world, like China and all the richest people in the world, they buy US Treasury bonds because that's the safest thing. They know they can get their money back if it's in US Treasury bonds, because we can print unlimited money to pay for it. When everybody buys the bonds, it puts pressure on the interest rates. So whenever people are buying them, that means our interest rates, we can basically borrow money from everybody in the world and all the countries in the world at very low interest rates. So it kind of gives America a free credit line to spend massive amounts of money on stimulus packages. So that's why there's talk of a fourth, because we're able to basically use this bazooka, and we would rather overshoot. To answer your question, Danielle, there is some talk of what would the fourth consist of, and right now it's just all just hearsay, and it's kind of dream scenarios. But for instance, I think Trump mentioned something about expanding the infrastructure across the United States, which both political parties have wanted for some time. A lot of people want a jobs program because we may need that to put America back to work if A lot of people got laid off. A lot of people are talking about this could be our chance to go for a Green New Deal, but we're likely to see some fixes too. So I would say unemployment, there's a lot of fixes in expanding unemployment benefits. I think we'll see that. I think we'll see an expansion on the TANF, which is another word for public assistance or in welfare, expanding that to taking off some of the caps and restrictions on that, and also SNAP, which is food stamps, expanding that because we may have many people trying to get these benefits, and we need money in their hands, and there's many ways to do that.
Okay, well, we'll be on the lookout for that fourth one when and if it comes. Probably will be coming soon. And hopefully, you have a better understanding of everything that is coming your way that you can access to help you in this crisis. So, if you like what you just saw, subscribe to this channel and then head over to toujourplanning.com to listen to episodes of our podcast, Wealth by Design, and to download our free wealth blueprint. And we'll include any of the links that you need down in the comments below. And we'll see you next week. We're going to continue coverage of this crisis as long as y'all need it. Thanks for watching.